If you have to pay for life insurance, how does it even make sense for you to make money inside a cash value life insurance policy? This is a great question that was asked in a comment. And in this video, I'm going to walk you through the 4 key components that'll just make this all make sense without getting too technical about everything. If this is the first time that we are meeting, my name is Nobu Musikiwa. I'm a licensed financial strategist. I help working professionals 40 plus save smarter and pay less taxes by creating a personal banking system using cash value life insurance. If you want to work with me to design your system for retirement or for real estate purchases, the link to work with me is in the description. In order for it to make sense to put money into life insurance as a savings vehicle, the first thing that needs to happen is that cash value policy needs to be custom designed. It has to be custom designed to do 2 things. First, to specifically fit the financial goal that you are trying to use this policy for. And then second, which is important across the board, is to make sure that more funds are going towards the personal bank versus more funds going towards the policy. If you get a regular policy or if the policy is not built out correctly where you have more money going towards the insurance, then the concern of, oh, I'm paying for insurance is a big concern because most of your money is going towards life insurance. In order for these policies to make sense, you have to have more money going towards the cash, and I'm going to get to why in a little bit. The second key to understand what goes with that custom design piece is that you will not be paying into this forever. Let's take a step back and think about something that we can apply with our everyday lives. If you think about your car insurance, right? Every single month or every single year, you have to pay for your policy. And if you do not pay, then your policy is going to be canceled, right? You will no longer have car insurance. Now, when it comes to your cash value policy, based on the design that you got, there's a specific dollar amount where once you hit that, you cannot put anything more into that policy. And if you do, you're going to trigger some tax events, which you don't want to, because the point of using these types of policies is also so you can grow money and take money out without paying taxes. And so, yes, part of your money is going towards life insurance, but you are not paying that life insurance out of pocket forever. So a practical example of a 40-year-old woman putting $1,000 every month into a policy for a pretty standard design for retirement without a lot of tweaks, the total she would put in would be about $240,000, and the projected amount in her personal bank at age 69 would be $714,000, and then age 84, $1.9 million. So even though there is a cost of insurance, the only thing that she has put out of a pocket is $240,000, and that $240,000 is going to blossom to a lot more than that over time, and the funds that are available take into account any funds that have been removed to pay for the insurance. And by the way, I'm currently working with a small group of people not to open one of these policies, but to understand what needs to be in the policy for it to be a good policy. That way, when they go speak to somebody, they are feeling confident. If you want to join that group while it's still running, the link is in the description. Which brings us to the third thing to understand, which kind of helps to bring the puzzle into how this even makes sense. We're going to bring it back to the car insurance, right? If your car insurance is $500 a month, that full $500 is going towards paying for your insurance, and that's it. When you are getting a custom designed cash value policy, we'll take that same $500. $100 could be going towards your life insurance, and then $400 is actually what you are paying above and beyond your actual insurance, and that $400 a month is what goes into your personal bank. So when you're getting these types of custom designed policies and you are choosing how much you're putting in each month, and say you're putting in $2,000 a month, $2,000 is not what you're paying for insurance. What you're paying for insurance is a small fraction of that. How much that fraction is depends on your age, depends on your health, depends on the policy design. But the reason why you're paying more than your cost of insurance is that with these types of policies, whatever extra you put in, your money is not just sitting there. Your money is getting interest based on how well the stock market is doing. But more importantly, whatever that money grows to is not going to get taxed. And also whatever you pull out of that policy is also not going to be taxed, because technically your money is in life insurance and life insurance does not get taxed. So if you were to overpay on your car payment, you just overpay and you give Allstate or whoever extra money, and that's fine. Like, they don't care. There's no extras that they're going to give you. But when you're overpaying to a custom designed cash value policy, well, that's a different story. You're overpaying strategically and only to the point where it is going to be beneficial to you tax-wise. And besides the tax benefit, the most important key is this simple math rule that we should have been taught in school, but we didn't, which is the rule of 72. This is super important when it comes to understanding why it's beneficial to save your funds in a custom designed cash value policy versus in a bank. If you're not familiar with the rule of 72, essentially it says if you take the number 72 divided by an interest rate, it's going to tell you an estimate of how long it's going to take for your money to double. So let's say you have $100,000 in your personal bank that you created with your cash value life insurance policy. And let's be conservative and say that the interest that you're getting is 7%. So if we take that 72 divided by 7, it's going to take approximately 10 years for your money to double. So if you have 100K in your personal bank, in 10 years, it'll be 200K. Now, if you keep that same 100K in a regular bank account, and let's say the interest is 1%, so 72 divided by 1, that means it's going to take 72 years for that 100K that you have to turn into $200,000. Also, let's remember, it's going to take 72 years for the money to double, and that little interest that you're gaining is also going to be taxed every single year. Versus if that 100K were in your personal bank using a cash value policy, that money could potentially double in 10 years. And in addition to that, there's no taxes on the funds that are growing while your money's in your policy. And also when you pull these funds out strategically, you can also access these funds and not get taxed as well. Now, while some of this may fit exactly what you're trying to do, this is a product that is not open to everybody and does require an application. In this video, I walk you through exactly what would need to be in place for you to get one of these policies. I'll see you there.